Hello viewers, in our session today we are going to continue our discussion on the valuation and verification aspect of other balance sheet items. In this session today we shall be taking up first and foremost the investments. Investments are the shares, securities and other stakes which the companies are holding in other companies. The following procedure should be adopted for verifying the investments. Obtain the schedule of securities and share in hand at the beginning of the audit period containing description, date of purchase, face value, market value, rate of interest, etc. Add to the above list the securities purchased and sold during the year. The authority should ascertain that investments made by entity are within its authority. Acquisition disposal should be verified with reference to the broker contract, note, bill of cost, etc. Every entity is supposed to maintain with it a schedule containing the details of all the investments held by it. Also, it has all the share certificates and securities with it in physical form. In case they have been pledged or they are lying with the bank or any other entity, then a certificate regarding the same should be obtained by the auditor. Whatever be the total of the investments, the addition or subtraction with those which have been added, that is purchased or sold off during the year, an adjustment should be made in that regard. And then the total lying at the end of the balance sheet should be appearing on the 31st March of the relevant year. Where the amount of purchases or sales of investments are substantial, the auditor should check prices with reference to the stock exchange quotation. The auditor should also physically inspect the investments. The auditor should satisfy that investments have been valued and disclosed in accordance with recognized accounting policies. The auditor should examine whether in computing the cost of investments, the expenditure incurred on account of transfer fee, stamp duty is included in the cost. So, the second aspect which requires the auditor's concern is that the physical possession of the investment should be there with the entity. For this, he should see that all the certificates are lying with the entity in proper lock and key. Also, he should see that the investments have been valued and disclosed at the right amount. The auditor should also see that all the expenses which have been incurred to bring the investments in possession of the entity, that is the expenses incurred on the stamp duty, transfer fees, brokerage, etc., has been added to the cost of the investments. Now, the investments in shares or debentures of a subsidiary. Firstly, the auditor should see that he has obtained schedule of all such securities containing the name of the subsidiary company, class of share, date of purchase, book value, dividend received, etc. All the particulars should be verified with the relevant account in general ledger. There could be instances that the entity is holding investments in many of its subsidiaries or other sister concerns. So, the investment could be lying in the form of shares or debentures of those concerns. The auditor should see that he has obtained a schedule of all these investments fairly by way of securities and debentures lying, and also he should see that the valuation of the same has been done in a prim and proper manner. Also, the amount should be verified with the general ledger of the entity. The provisions contained in Part 1, Schedule 6 of the Companies Act 1956 require that the shares in subsidiaries should be shown separately. Shares or debentures of a subsidiary are valued at cost. If subsidiary has suffered a loss, a provision for proportionate part of the loss should be made in the accounts of the holding company. Here it should be recalled that a holding company is one which holds at least 51% of stake in another company. The other company hence becomes a subsidiary company. So, whatever be the value of the shares, they should be disclosed at the value of the investment should be disclosed at cost, for which it has incurred by purchasing the shares of the subsidiary company. Now, the investments in capital of a partnership firm. The investment is to be disclosed separately. The auditor should go through the partnership deed, noting the capital contributed by the company, P&L and balance sheet duly audited. The company's share of loss or profit should be duly accounted for in company's P&L account. The auditor should see whether the firm has been duly registered. So, in case a company has put its stake in a partnership firm, the same should be disclosed in a separate heading. It should not be shown with the other rest of the investments which the entity holds in other companies or by way of shares or stocks. The auditor should also see that it has gone through the partnership deed to know about the capital contribution, the profit and loss and the balance sheet disclosures. Now, we will be discussing about the intangible assets which are held by the entity. The first and foremost being the patents. The ownership is verified by inspection of the certificate granting the patent. It must be observed that rights are alive and legally enforceable. It should be verified that renewable fees has been paid from the revenue. The auditor should ensure that patents are shown at cost less amortization. Cost of patent should be written off over 10 years as suggested by the accounting standard 26, unless there is a clear evidence that useful life is longer. Now, patents are the rights which the company holds particularly for manufacturing a novel product or a new product. Now, this kind of intangible asset has to be amortized over the useful life period of such a patent. If the useful life is exceeding 10 years, then a note to that regard has to be disclosed. Otherwise, it should be amortized or written off in a period of 10 years. The next one is the trademark and the copyrights. The existence of trademarks is verified by inspection of the certificate granting the trademark. It must be observed that rights are alive and legally enforceable. It should be verified that renewable fees has been paid from the revenue. The auditor should ensure trademarks and copyrights are revalued at cost less the amortization. Cost of trademark and copyright should be written off over a 10 years as suggested by the accounting standard 26, unless there is a clear evidence that useful life is longer. So, the same provisions which are applicable to the amortization of the patents also are applicable to the trademarks and copyrights, since they are also the intangible assets. The trademarks are the logos which are used by the entity to market its product, and copyrights are the rights for the further publication and making of copies of the books written by the authors. So, both of these rights, if the entity has expended for the acquisition of these rights, then they should be amortized within the period of 10 years until and unless a further period can be justified. Now, let us discuss the assets which are lying abroad of the entity. Where documents of title relating to the assets held abroad are not available for inspection, a certificate should be obtained from agent or any other holding agent. Such certificate must disclose unequivocally that they are free from any charge. The auditor should state in his report whatever evidence has been produced for verification. Here it is to be noted that though there is the responsibility on the auditor to verify all the assets, whether the existence of the assets or it is the title of the assets that he has to verify, but it is not actually feasible to verify the assets which are lying abroad. Hence, at the most a certificate or the title deeds can be inspected by the auditor. In case the title deeds also are not available by the entity, then a certificate by an agent can be relied on. Also, a note to this regard should be made by the auditor in his audit report. The next one is the development of property. Now, these are expenses when incurred for the development of any property and which cannot be added to the value of asset. These should be capitalized under this head. Such costs should be written off over the period during which benefit from such development will accrue to the business. These expenses should be verified with reference to the budgets, sanction, technical report and bills of actual expenditure. These are general expenses which have been incurred for the development of various kinds of properties, and hence a demarcation cannot be made about the expenditures which have been incurred for a particular property. This development of property expenses are clubbed together and they are amortized over the useful period of the benefit received from such property. The next one is the railway siding. For verification of this item, it would be essential to refer to agreement with the railway for availability of the facility. All expenses connected with laying of the rails and making individual agreements should make up the cost. The cost of the railway siding should be appropriately depreciated, keeping in view the terms of agreement with railway. Many of the companies who are usually manufacturers of big machinery have to transport their machinery through the railways. Hence, a private agreement with the railways is entered into by these entities for the setting up of the railway sidings. Now, these are the assets which are actually coming up and should be amortized over the useful period according to the agreement entered into with the railways. Now, we shall be discussing about the current assets. The first one being the stock in trade. An auditor should verify the existence of the stock in trade and the same has been valued correctly. It is no part of the auditor's duty to take the stock. For that purpose, he can rely upon the statements made available to him so long there is no circumstances which may arouse his suspicion. Auditor would be failing in his duty if he does not take reasonable care in verifying the statement of stock. Part 2 of Schedule 6 to the Act prescribes that opening and closing balances be disclosed in P&L account and mode of valuation to be shown on the balance sheet. Now, we have to reaffirm over here that the auditor is not a bloodhound. He is not supposed to look and be suspicious about any of the blunders or any of the manipulations being done by the entity. Hence, his entire responsibility is to see that everything which is disclosed is fair and proper, and reasonable safeguards have been taken while controlling the verification and valuation of the stock in trade. Hence, no duty is cast on him to take the stock. Actually, it is the responsibility of the entity to check the stock, take the stock and disclose it. The auditor has been cast only with the nominal duty of verifying that all these controls are occurring properly, and he should at least visit once while the stock is being taken. The next one is the verification of the inventories. The responsibility for properly determining the quantity and value of inventories rests with the management. Verification of inventories may be carried out by employing the following procedures. The number 1 being examination of records, secondly attendance of stock taking, thirdly obtaining confirmation from the third parties, fourthly examination of valuation and disclosure, and lastly the analytical review procedure. Hence, the auditor has to go through all these 5 steps to safely presume that everything is being carried out prim and proper, and that the verification and valuation done by the entity is as per the records which is being disclosed in the balance sheet. So, firstly he has to check all the records, secondly he has to verify that a proper procedure of stock taking is being done, thirdly he has to obtain the confirmation from the third parties in case there is a discrepancies or inconsistency shown in the records. Fourthly, he has to see that the basis of valuation of the stock in trade and the inventories is proper, and lastly he can apply the analytical review procedure by which he can calculate the ratios and see that they are falling in line with the previous years also. The next one is the examination of the record. The entity usually maintains the detailed stock records in the form of stock ledgers showing receipts, issues and balances. The extent of examination by an auditor depends upon the facts and circumstances of each case. The second duty which the auditor has to do is attendance of the stock taking. Physical verification of inventories is the responsibility of the management. However, it may be appropriate for the auditor to attend the stock taking where inventories are material. The extent of auditor's attendance at the stock taking would depend upon his assessment of efficacy of relevant internal control procedures. Now, there are two principal methods of stock taking. Under the periodic method of physical verification is carried out at a single point, usually at the year end, and under continuous method physical verification is carried out throughout the year. The auditor is expected to examine the adequacy of the methods and procedures followed by the entity. Now, the auditor, while attending the stock taking which is being done by the entity, he has to perform certain duties. The first one being that the auditor should also perform test counts to satisfy about the effectiveness of the count procedures. The second is proper attention should also be paid to physical condition of the inventories. The third one being that the auditor should determine whether procedure for identifying defective, damaged, slow moving items of inventory are well designed and operate properly. There is a system of always better control or ABC analysis which is followed by the entity while maintaining the stock. Hence, the auditor should see that such kind of system is adopted so that there is better control over the stocks which are slow moving, also those stocks which are fast moving and of high value, also those stocks which can be easily pilfered. Hence, all these things should be taken into mind, and the auditor can suggest ways in which the entity can maintain the stock in a more efficient manner. Now, where continuous stock taking method is used, the auditor should pay attention whether adequate stock records are maintained, physical verification procedures are satisfactory, material differences between book records and physical counts are investigated and corrected. In a continuous stock taking process, many of the inefficiencies followed while stock taking is done could come to light, and hence the auditor will be in much better position to suggest ways and means to correct these problems. He can also tell the entity about the material differences which occur between the book records and physical counts, and these could be investigated and corrective measures could be taken. Now, as the confirmation from the third parties, the auditor should examine that third parties are not such with whom it is not proper to keep the stock. The auditor should also directly obtain from third parties written confirmation of the stocks held. Now, it is quite possible that the entity does not have adequate storage spaces or godowns for the purpose of storing the inventories. Hence, the inventories could be stored at some other sites which are called as third parties. It should be told by the auditor that it is not a proper practice to maintain the inventories with the third parties, because then proper control over the inventories cannot be made, nor proper accounting could be done. Also, the auditor should see that he obtains a certificate from these third parties regarding the maintenance of the inventories, the total quality and the quantity which is maintained by them. Examination of valuation and disclosure. The auditor should satisfy himself that the valuation is in accordance with the generally accepted accounting principle. The auditor should examine the methods of applying the basis of inventory valuation. After being satisfied with the verification aspect relating to the inventories, whether they are lying with the entity or with the third party, and the process of counting and physical existence of the inventory, the next aspect which the auditor has to consider is the valuation. Hence, the method of valuation should be disclosed by the entity to the auditor, and the auditor has to see whether it is adequate and proper with regard to that particular inventory. The auditor should examine the stock sheets, records of physical verification, invoices, costing records and other relevant documents to determine the cost. The auditor should examine evidence supporting the assessment of net realizable value. The auditor should satisfy that inventories have been properly disclosed and statutory requirements are complied with. There are a lot of materials which the auditor can obtain from the entity to verify the existence of the stocks and the valuation of the same. He can obtain from the entity the stock sheets, the ledgers, the invoices, costing records and other relevant documents to satisfy himself. Also, he should obtain evidence from the third parties who are holding the inventory of the entity. He should also see that the inventories have been properly disclosed and the statutory requirements with accounting standard 2 relating to the valuation of inventories have been complied with. With this, we are concluding our today's session. In our session today, we had discussed about the verification and valuation aspects related to the investments. Also, we discussed about various other assets like the railway sidings, intangible assets like the patents, copyrights, trademarks, etc. Also, we discussed about the inventory verification and valuation and the duties related to the auditor with regard to the same. I hope you enjoyed the session. Thank you.